Good morning, everyone. Thank you for joining our webinar, Alliances for Green Infrastructure, State of Watershed Investment 2016. I'm Will Tucker with Forest Trends. We're joined today by Genevieve Bennett, who is the author of the new report of the same name from Ecosystem Marketplace. She's also a Senior Associate for Water and Biodiversity. Daniel Shimmy is the Director of Strategy for Water Funds within the Nature Conservancy's Global Water Team. And Brian Van Wy is the Chief of the Program Implementation Branch of the Stormwater Management Division within the District of Columbia's Department of Energy and Environment, otherwise known as DOEE. If you haven't yet had an opportunity to download the new Ecosystem Marketplace report, you can do so at either forest-trends.org or ecosystemmarketplace.com, all one word. The structure of the call today will be approximately 45 minutes of presentations, followed by hopefully 10 or 15 minutes of question and answer. For those of you who aren't familiar with this webinar software, all participants are muted by default, so we won't have too much background noise. We'll be recording this, and it will be subsequently posted to the website, also sent around to everyone who's registered. Many of you are probably using audio over your computer. If you find that the audio quality is not sufficient, you might want to try calling in. You can select the phone call option on your audio section of the control panel, which will boot you from the computer audio, at which point you'll see a phone number and passcode. For questions, you can either raise your hand using the attendee box within the control panel, or you can submit written questions via the question box. If you raise your hand during the presentation, I'll go ahead and unmute you at the end of the call in the order in which you've raised your hand so that you can ask questions verbally. Otherwise, we'll go ahead and record all of your questions during the call that are submitted via the question box and ask them to our panelists in the order in which they're received. Participants who are connected via phone only, I would just want to point out that although you'll be able to hear the entire call, we can't see that you're on the webinar, nor will you be able to speak. So I'm sorry about that inconvenience. Without further ado, I'm going to hand it off to Genevieve Bennett, who again is the author of the new report from Forest Trends Ecosystem Marketplace and Senior Associate for Water and Biodiversity at Ecosystem Marketplace.
Thanks, Will. Good morning, everybody, and thanks for joining. Before I get started, I wanted to ask you all to respond to this poll that my hope is has just opened up in your control panel, and tell me who you are and where you're coming from. And this is neat. I'm watching it update live. It looks like we are pretty evenly split between NGOs and donors are pulling ahead a little bit of the private sector. Great. Well, thank you all. We'll let that run. And as Will noted, I'm going to, really what I'm going to try to do is provide kind of a high-level overview and hopefully tee up our other panelists based on findings from a new report that we're releasing, which is the latest in our State of Watershed Investment report series. It's actually the fourth one we've done, looking at the size and scope and scale of markets and incentives for green infrastructure. And I do want to recognize my co-author, Franziska Ruff, who is not able to join us this morning. And also I wanted to thank our sponsors on the report, the Swiss Agency for Development and Cooperation, MacArthur Foundation, and Good Energies. So before I dive into findings, just a quick introduction to Ecosystem Marketplace for those who aren't familiar with it. We are an initiative of Forest Trends, which is a Washington, D.C. based NGO that works to conserve forests and other ecosystems through innovative environmental finance and market-based mechanisms. And Ecosystem Marketplace is kind of the information arm of the operation. We're a web-based platform, and we provide original news coverage and data and market intelligence on environmental finance and markets and payments for ecosystem services. So, I think right off the bat, what is green infrastructure and why do we care about investment in it? A pretty basic definition that you all can hold in your minds is that green infrastructure is the places or features or practices where you are protecting or mimicking natural hydrological processes. And so these can be untouched natural areas like that glacier you see on the screen here, or it can be semi-natural or newly created features like an urban rain garden. And as for why we should care about it, I think as beautiful as these glaciers and these sand dunes that you see are, this is not just a conservation issue, it's really a water infrastructure issue. There's a huge gap right now between our current water infrastructure systems and where we need them to be if we're going to meet the pretty basic human need of reliable access to clean water for everyone on the planet. And I know when we think of water infrastructure, there's a tendency to think about filtration plants and aqueducts and other built systems. But green infrastructure is a critical part of our water systems as well. Healthy landscapes can help reduce the work that our built infrastructure has to do to clean and convey and store water. It can extend the life of those built elements, in some cases improve their return on investment. I think additionally it's important to note that a lot of these green solutions don't require enormous upfront capital, but they can be scaled up kind of as you go, which makes them more flexible. It makes them adaptable to a changing climate and to changing human needs. And so one of the goals of this report series is to really advance this idea of hybrid infrastructure systems that incorporate both green and gray elements. That said, this is also definitely is a conservation issue. Green infrastructure can provide a lot of benefits beyond water. Think of things like wildlife habitat and carbon storage, places for recreation, or where we find cultural or spiritual significance. I also want to review the report scope quickly. Oh, gosh, I'm so sorry. You guys can't see the screen. Let me close the poll out. Okay, I'm so sorry for that. So here's that slide that I was showing you just a moment ago with that green-gray infrastructure spectrum. Now moving on to the scope of the report, we focus specifically on transactions for watershed protection where financial value is exchanged for activities or outcomes that are associated with watershed management or protection. We use the term investment in the sense of a long-term investment in an asset, so these are not necessarily investments in the sense of a real financial return, although that does happen. But more often, I think the returns that we see or that are targeted are cleaner water, right, or avoided costs or benefits that are accruing to the community as a whole. So we track these transactions through a global survey of programs. We ask them to report to us on their activity in 2014 and 2015, and we supplement that data with interviews with program developers and other actors in the space, desk research to fill in gaps, to verify, what we're hearing from project developers, and to make sure that nothing's being double counted. We do report only on what's reported to us, so we don't extrapolate from any of our data. And I think, well, as far as I know, this is the most comprehensive inventory of these mechanisms around the world. Of course, we can't guarantee that we're going to get to everyone or that everyone's going to respond to us. So, please keep in mind that these numbers are probably on the conservative side, and I would encourage you to take a look at our methodology and understand it. But here you can see in this map, these are all of the programs that we tracked this year. So on to the findings. In 2015, we benchmarked almost $25 billion of transactions flowing into watershed restoration, management, and protection. That's our highest value to date. Most of these transactions are originating in Asia, in particular in China, and as well as Europe and North America. And digging a little more deeply into that $25 billion figure, we see 4 core models for watershed investment that we basically can distinguish between in terms of on whose behalf the investment is made. So, are we talking about someone investing on the behalf of the public good, or are these, benefits directly accruing to users or a polluter pays situation. We can also look at how market-like the mechanism is. So when I say that, I mean, number one, is there a standard unit of exchange that's traded? Are there transactions between many buyers and sellers? Are prices affected by the laws of supply and demand? And we've got kind of a simplified matrix here. But you can see those four mechanisms that we track: public subsidies for watershed protection, user-driven watershed investments, environmental water markets, and water quality trading and offsets. I'll freely say some programs blur these lines or land in different places along these spectrums, but I think that this is a helpful way to think about this money. When we return to that 25 billion figure and break it down in this way, you can see that public finance is really dominating the action. And I'm going to, in the next few slides, speak very quickly to each of these four mechanisms in turn. So starting with public subsidies for watershed protection, we see that most of the global payments for green infrastructure that we track is originating with public actors, mainly at the national scale, funding watershed protection really on behalf of the public good. I mentioned that this is the fourth report we've done, and over the years China has consistently led in spending and consistently ramped it up as well. And as you saw on the last slide, these public subsidies are paying for landholders and public land managers to manage for watershed health on almost 427 million hectares of land, which Wikipedia tells me is just about twice the size of Greenland. So this is a big deal, and it's an encouraging finding that we're seeing growth. I think that what we're really seeing is that governments are kind of taking the traditional subsidy, agricultural subsidy model and modifying it to create incentives for healthy landscapes rather than only for commodity production. The second mechanism that we look at are watershed investments that are driven by water users themselves. So think of cities and companies or water utilities who have decided to take direct action for water security and pay for it themselves directly. Since these initiatives are more locally driven, they do tend to be smaller. We find about $657 million in payments from water users in 2015, with the largest share of that coming from state, provincial, and local governments. Those two groups provided just about 8 out of every $10 transacted. We also do look at private sector spending on green infrastructure, found a little bit over $15 million in payments led by the food and beverage industry, and that's pretty consistent with previous years. So in these, in this user-driven space, I think we're also seeing a really interesting move away from the single buyer model where you have just one utility or company kind of working alone to influence land management. Instead, we're finding almost 9 out of every $10 spent in 2015 was tied to a collective action partnership where you see water users voluntarily cooperating to pool resources and to coordinate efforts. I think that's a really good sign in terms of both basin management being a collaborative effort. We had programs in 2015 reporting an average of 3.6 buyers each. And also in terms of financial sustainability, you see less dependence on a single buyer who may not be able to maintain funding forever. Turning to water quality trading and offsets, we had a banner year here with almost $32 million transacted in 2015, and that represents a pretty big jump from the last report where we found a little under $21 million in trades in 2013. Most of this growth is in new markets, particularly for permanent offsets in the United States. As you can see in this figure, we actually saw volumes decline in 2015 in some long-standing markets, but that was more than matched by new growth. And declining volumes in some cases I think you can actually interpret as sort of a sign of success. We're seeing markets hit their water quality goals and trading kind of wind down as a result. I'm mindful of the time here, so I would encourage you all who are interested in trading to take a look at our report. We look at some of these dynamics in more detail and also look more closely at performance in specific markets and report on volumes and average prices there. So moving on to environmental water markets, that term referring to mechanisms where surface and groundwater rights are purchased or leased essentially in order to not be used but rather kept in stream or kept in aquifers. We saw a global slump in spending continue in 2015, and that's mainly driven by the Australian government continuing to dial back its investment in the Murray-Darling Basin, mainly over concerns about conflicts with agricultural water users. But we do see kind of slow and steady growth in the western and midwestern United States. And in 2015, spending in the U.S. actually nudged ahead of Australia for the first time. And there's an interesting kind of shift in the U.S. towards leasing and more flexible contracts, I think in an effort to get out in front of some of these problems that they've run into in Australia over, impacts on agricultural and rural economies when water rights are being purchased for environmental reasons. And that's an interesting development, I think, and one that we do discuss further in the report. Okay, so now we're going to step back from mechanisms and look at the buyer side. We asked programs to report on how their buyers are deciding which projects to fund, and unsurprisingly, location is the most important factor for most of the buyers. Presumably they're looking to benefit from land management in the basins where they operate or where their customers or suppliers are located, and so location matters. That said, nearly as many said that they're making their spending decisions based on other factors like cost or co-benefits, fit with the organizational mission, or the project just being a good opportunity to demonstrate green infrastructure benefits. Looking at co-benefits, buyers primarily interested in co-benefits most often said biodiversity conservation, was their core interest. And then looking at this group of buyers as a whole where location isn't the #1 factor for them in influencing spending decisions, there's some interesting dynamics when you break it out by sector. So for some sectors, cost is really looming large, and for others, co-benefits are kind of the main interest. Projects also reported to us on specific co-benefits that they're managing and measuring, and here we have a quick breakout on how many programs were able to report on co-benefits and a closer look at just one, employment and training, and some of the impact metrics that we collected there. And we have a really, I think, great infographic in the report breaking down all of these different co-benefits in terms of specific impact metrics that programs are using, which I would encourage you to take a look at. And the last finding that I wanted to highlight today is this question of, what are the barriers to scaling up green infrastructure investments? We asked programs to kind of give us their top 3, and these are the 10 most commonly reported across the globe. And #1 is regulatory uncertainty. Are there legal constraints to investing in watershed protection if you're a utility or a government, a city? Is this an acceptable way for you to meet compliance if you're a company? But we also found a lot of programs are really telling us that capacity is an issue. Things like managing funds and identifying project sites and demonstrating benefits to stakeholders and potential buyers. And I'd be interested to hear our other panelists respond to this, if this is a challenge that they see in their work or something that they found some solutions to. I think it's important because I know in this space there's kind of this common wisdom that the constraint is money, right? That people aren't willing to pay for green infrastructure. But one of the things that I think we saw in the report this year and in a forthcoming report from Ecosystem Marketplace on private investment and conversation that'll be out in January is that there actually is quite a lot of finance waiting in the wings for green infrastructure. I think at minimum it's hundreds of millions of dollars, and it may be much higher. But there is a need for more sort of shovel-ready projects in the pipeline that are ready to accept that funding. And so there is, I think, a question of, how do we scale up technical and financial capacity more quickly so that we can start implementing green infrastructure at, the scale that's probably necessary to keep pace with water risk. And so I will stop there. And again, that was only a quick look at findings. There are a lot of things covered in the report that I didn't talk about today here, issues like regional developments and demand drivers to watch and how programs are measuring and verifying their performance. So you can follow that link to download the report, and I think we'll send it out again at the end of this webinar, and I will turn it back now to Will and our awesome panelists. Thanks.
Fantastic. Thanks, Genevieve, for that presentation. Now we'll kick it over to Daniel Shemy, who, to remind you once again, is the Director of Strategy for Water Funds within the Nature Conservancy's Global Water Team. Apologies for the radio silence, everyone. We're quickly resolving an audio issue with Daniel's connection. Should just be a moment.
Hello. Anyone hear me?
We've got you now. Thanks, Daniel.
Oh, geez.
Good
Okay.
to go.
Thank you. Thanks, Will. Apologies, folks. There's no matter of preparation that you can avoid that. Can you, Will, can you confirm you can see my screen?
Yes. Looks great, Daniel.
Thank you. Thanks, Jen, and thanks to Forest Trends for inviting the Nature Conservancy and myself to speak on this important topic. Pretty exciting numbers coming out of that at the global scale. Just situate you where the Conservancy fits into this and what we mean by water funds. For those of you who know the New York City Catskill story, a famous payment for watershed services agreement, and actually where I get my own water fund, then you'll know already, you already have a head start. The Conservancy specifically invests in that kind of user-driven type of watershed conservation. And this picture here is the Pacton Reservoir, one of our major water sources now, only 125 miles away from where I drink water out of the tap. But if you look at it, at least to me, it's a reminder just how influential this kind of investment can be, because just look how remarkably beautiful that landscape is. Moving on, though, I wanted to underscore exactly that, the difference. Jen mentioned that what still dominates the bulk of watershed investments are the public subsidy model. This is a whereby our national and provincial governments are paying in on a kind of public good basis. But just like that New York story and that you're all already familiar with, we see a lot of scalability, particularly in this user-driven model, whereby multiple buyers are investing in on a regular basis into their watershed health. To give you some sense of why we may have an opinion, we have about 150 TNC staff working on this program. In the last 15 years, we've raised about $300 million on the back of it and protected around 300,000 hectares. That's about the size of Yosemite National Park, for those of you who are counting. And we do this as ever through partners, now in numbering in the hundreds, but also remarkably in about a dozen countries. And while we have about 29 of these collective action water funds in operation, we have about 30 more in design. And you can see from this map on the left here that a lot of this work has happened in Latin America, but also here in the United States and where I'm calling you from. And then increasingly, and I think excitingly to me, in East Africa, China, and Indonesia. So that's kind of the reason why we have an opinion about this, is because we spent a lot of time addressing the very challenges that Jen went over. And I wanted to kind of revisit that figure that Jen closed with, because I think it's a really important one. To her point, it's a little counterintuitive. You would think that at the very top of operating programs, you'd say money, money, money. But I think what you see here reflects an important distinction. Once you're in a program, your challenge is actually much more around implementation. There is obviously a temptation to think that if only we had money, but there are major challenges that I'd like to draw your attention to in implementing large landscape scale investments. And so it's not terribly surprising to me that the top two here are that concern around stakeholders, that stakeholders, not just buyers, are a preoccupation of watershed programs. Likewise, this regulatory, which I think is important to distinguish from kind of higher level policy, that regulations can both be a major obstacle or a major enabler to getting investments out into a landscape. It's also remarkable that at the bottom of this list is exactly that point, that the challenges to securing buyers within existing programs, that may be a bias there, is not necessarily at the top, the universal challenge amongst programs. But likewise, the lack of support amongst policy makers. Now that, again, counterintuitive given our traditional focus on in the sector around creating champions and moving laws. Now all of this is of course worthwhile investments, but I think what it also suggests is that you can pull off these programs in geographies without major policy change. And that's not to say that efforts to make policy changes that favor watershed investments aren't worthwhile, but there is something, I think, emboldening to our sector that you can make pretty important impacts on a landscape while not necessarily changing laws. So Jen and Will have asked me to kind of reflect on some of the challenges, not just within a single program, but some that we see in scaling source water protection across multiple geographies. I have to say that's one of the perks of my job, that I've visited nearly all of those water funds on the map a couple slides ago, and in doing so, I certainly have been able to detect a few trends. But I'll also point this audience to an upcoming report that the Nature Conservancy and Forest Trends are launching on January 12th. Yes, another report. This one's called Beyond the Source. They'll be launching, and we, as co-authors, get much deeper into some of these questions of challenges and recommendations. So, of course, the top four challenges here shouldn't be totally surprising, but financing, how you both get enough resources and how you get them on the ground. That participation point, the social acceptance of absorbing an investment across what is often a disaggregated landscape, highly fragmented landowner situation. Again, favorable generating, overcoming perverse regulations that favor one specific procurement track, or creating the kinds of regulations that ask decision makers and investors to consider green infrastructure alongside their traditional investments. And then finally, this capacity challenge that we face on a day-to-day basis within our organization, but that we also see across our partners in the geographies we work. So I want to take a more of a positive note, but again, echoing Jen's point here, on the left side here is kind of a typical cash flow for many watershed programs. Money in, money out. Nature is this incredible thing that the benefits are not always linear, but they, if you're going to be working with landowners and you want to pay them to do something on their landscape, well, you can pay them every year. This is kind of the rental model. It dominates our work at the minimum. But I have to say that if you want to bridge the gap between the billions of dollars that Jen and Forest Trends have identified that are already going into watersheds, and you want to bridge them to the amount that we need, borrowing against future payments is a really compelling approach. It would essentially give these programs, ours included, the capital they need up front to make kind of landscape scale, system scale investments, then repaying both those costs and the cost of capital over a long time. Now, that second cash flow on the right is actually the way that many in the water sector think about typical capital investments. There's no water treatment plant that works if you've only built about 90% of it. You need to build the whole thing to reap any benefit. Now, watersheds don't behave like water treatment plants, but they are equally susceptible to larger scale investments. And not only is that a good way of securing and front-loading the benefits of watershed and source water protection, they also increase the certainty with which you can secure the outcomes you want out of a watershed, those hydrological benefits that so many and environmental benefits that society values. Namely, because if you're able to secure in the first several years of a program's existence full participation amongst landowners, you're able to make your investment in that landscape, make the landscape change, those changes are likely to remain permanent. If you are banking on making a change in year 15, well, we know that in year 15 the mayor may have changed, the political landscape may have changed, and that presents some challenges. So there may be also not only economies of scale that a program can accrue by investing more upfront, but also can improve the certainty with which those outcomes in our models will achieve. So this is not complete theory. A program that we support at the Conservancy here in the United States in San Antonio, Texas, uses a bond mechanism on the back of a voluntary 1/8 of a cent sales increase to pay for the protection of the Edwards Aquifer recharge area. Now that's incredibly important to San Antonians, in part because the Edwards Aquifer is its single groundwater source. And so on the back of this bond offering, the city has raised about $225 million to date. So you're talking about getting to a scale of financing that I think is commensurate with the challenge of watershed degradation and recharge area impairments. And in doing so is really on the back of future revenue streams. I wanted to dwell on this point around social acceptance and participation because I think it's just so critical. Even if you have those resources, we notice in a number of programs that even where the funding exists, it doesn't necessarily mean that there are turnkey projects out there prepared to absorb a lot of capital up front. This is certainly the case in our programs in many geographies, including Peru. But I wanted to draw your attention to a very new program. This one's in Illinois, and it looks not unlike the figure on the top. This is a highly agricultural dominated watershed, not at all like the Catskills where it's nearly 94% forested. This is nearly 94% row crops. And it's a geography where there's both incredible aquatic ecology, but then this really highly managed landscape. Now, we have a lot of good science that suggests that working on even just a small portion of that agricultural landscape with saturated buffers, wetland installation, fall to spring fertilizer application, cover crops, between these kind of edge of field and infield practices, you can see a really dramatic decline in the amount of nutrients running off this landscape and into the two water reservoirs that serve the city of Bloomington downstream. Now, it doesn't really work, though, as in many of our collective action challenges, if only a few farmers participate in the program. And this is why, at least in this program, we are exploring a kind of voluntary approach as ever. The water funds are very much predicated on land stewards participating and their willingness to participate. Nevertheless, though, we are kind of asking ourselves and asking that community if we can get to a minimum level of participation before we spend another dime on wetlands and farming practices. In part because we know that our buyers and the system itself only really functions once we get to a critical mass of participation. So that's one. There's a number of specific mechanisms you can achieve that, but I'll seed that in your head as a way of achieving the level of social acceptance and participation to have a meaningful impact. The second one is in a completely different geography, in a completely different social setting. You can imagine in Bloomington, in the Midwest, in Illinois, these are very large landowners, large formalized land rights. In the Upper Tana, the drinking water source for Nairobi, where we have a water fund, only 2 years old now, you're looking at a very different land holding situation. We're talking about very small landowners here, 1 to 2 acres. Think about your backyard garden, that kind of scale. And we're talking about, you know, hundreds of thousands of landowners, many of whom their land rights are not formalized. And so how do you achieve participation at a meaningful scale in that landscape, even assuming you have all the resources in the world? Well, there, partnership becomes the big part of the game. The transaction costs for the Conservancy or for Nairobi Water or KenGen, Nairobi's hydropower operator, to engage these farmers would be prohibitive. But by working with 2 critical partners, one from the private sector and one from civil society, we are already achieving a level of participations in the tens of thousands. So I'll highlight one on the civil society and one on the private sector side. The Green Belt Movement is a civil society organization that has been working in the Upper Tana on a number of issues, not related to the environment, but much more around food security. And so they have already in place a kind of extension worker workforce and a built-in trust and a built-in relationships across a number of farm cooperatives that allows us to kind of partner with them and use that in-place capacity. Now that's an exceptionally great enabling condition for doing source water protection, is to have civil society capacity in place. Now another example within that Nairobi context is the existence of a number of agricultural buyers who are buying the tea, the coffee coming off this landscape. One with whom we are partnering very closely is Frigoken. Frigoken is a large, well, medium large in the global sense, but large in the Kenyan sense, agricultural buyer, cash crop buyer. If you've had snow peas in the last year, you're probably buying them from Frigoken. Now, when they look at their ag supply chain, they're concerned about the reliability. These are not highly productive farms. There's a lot of capacity that needs to be built on those farms, and so we've been able to partner with them on the basis that the conservation practices we're trying to promote on that landscape also increase the reliability of the crops coming out of that landscape and into the barges and trucks coming out of Frigoken processing plants. I'm going to speed up here a little bit just because I'm conscious of time, but I wanted to just flag 2 more examples. One of the policy and regulation. Now, obviously, regulation can be an obstacle to doing this work, but it can also be a pretty incredible enabler. Our colleagues and partners in Peru have recently passed a tariff restructuring which includes a portion of water tariffs for the environment, for watershed conservation. Now, just as I said before, having the resources, which now are in the tens of millions in case of Peru, doesn't mean you necessarily have the absorption capacity in the watershed, and we're working with them to sort that out. But I think it does provide a pretty exciting model at the policy and regulatory level if you really want to mainstream the inclusion of the environment within our water tariff structure. And then coming at this last point around capacity, within our Latin America program alone, we have had to turn down about 30 requests for source water protection programs in the last year. Now that's in part because of our own capacity limits, but also it's a testament to the demand amongst the kind of user base who are looking to secure their water supply by investing in watersheds. So there is a capacity gap that we've noticed, and I think that Forest Trends survey also underscores. There's also a lack of standards in our work that I think we have to be very honest about. We don't necessarily have the track record of traditional gray infrastructure yet, and that track record, getting more of it may depend in part on the kind of codification of what we mean by not only green infrastructure, but also what we mean by payment mechanisms to achieve that. You know, just as a counter argument, Jen pointed out to me at one point that in the forest carbon world, you're talking about 90% of those programs being verified by a third party. Now, we don't have that same level of certification process, the same level of standards in the payments for watershed services world. And I would argue that the closer we get to that standardization across different organizations, the more both credibility and predictability new buyers will have when they look at these programs. And so the lack of capacity and in part the lack of the standards, I think, is you know, creating a bit of a reinvention of the wheel. It's something that I see in my work, and that I think that there's a couple pretty low-hanging fruits to solve. One is, you know, development and the refinement of the recipe. So this is something that the Conservancy, alongside Forest Trends and others, are investing in, the toolbox and the training, right? I mean, we want to not only have codified the knowledge in how we achieve best practices, but we want to also start building the capacity to train more and more cooks. So I will just close on that note and include here on my final slide a link that I encourage those of you to click on, or if you'd like to send me a direct message, I can send it to you as well, where the Conservancy and partners are really trying to think in a pre-competitive way about how we might invest in the tools, capacity, and knowledge-sharing instruments to equip many more communities around the world to protect their water sources. Thank you.
Great, thanks, Daniel. That's a really interesting perspective, and I think we all really appreciated that. Next, I'll just quickly switch gears to Brian Van Wy, who, just as a reminder, is the Chief of the Program Implementation Branch of the Stormwater Management Division within the District of Columbia Department of Energy and Environment.
Hi everyone, can you hear me?
Yes, loud and clear. Thanks, Brian.
Okay, great. Thanks to Daniel and Jen and Will for all that. It's really interesting stuff, and it's interesting to hear about sort of the global state of these kinds of efforts. So I'm, I guess, bringing it into a really local context in Washington, D.C. and talking about how we're trying to scale up green infrastructure. When I'm talking about green infrastructure, I'm talking specifically about green infrastructure that reduces stormwater runoff, like green roofs and bioretention. And over here in this picture, we have a cistern system that's capturing stormwater to use it to flush toilets. So basically, stormwater runoff reducing green infrastructure. And I'm focused on the municipal separate storm sewer system part of the city, the MS4. We also have a combined sewer area of the city where the raw sewage and stormwater combines together. Currently, there is a big tunneling project underway to deal with this overflow problem. So our primary focus is on the MS4 at this point, sort of on the green area of the slide. Our problem is that our estimate of the cost to retrofit the MS4 area with green infrastructure is upwards of $7 billion, and we have about $10 million a year to do that work. We realized several years ago, based on previous stormwater management regulations that we had in place, that if we could pass new regulations that would require regulated development to install green infrastructure, we'd be able to get a huge amount of green infrastructure installed in the city. In fact, we realized that the scale of that development is big enough that we'd be able to get 10 times the green infrastructure that we're able to achieve with all of our voluntary and subsidy programs combined. And we have some really fantastic subsidy programs that we're really proud of, but it's just the scale of development is so big. The challenge is that regulating development in many places, including Washington, D.C., is sort of an inherently controversial thing. We had tried to revise our stormwater management regulations previously and had failed in that effort. And one of the things that we heard from the development community in that process was that in order to put in place new regulations like this, we would need to provide a lot of flexibility. And so back in 2010, I was charged with sort of trying to get a new regulatory framework developed, and we had an MS4 permit, a Clean Water Act permit being issued to the District of Columbia by EPA that in a draft version had a requirement for us to put new regulations in place, but that permit could easily have been bogged down in legal challenges. Our development of regulations could easily have been bogged down in legal challenges, and we really didn't want that to happen. So we really sort of rolled up our sleeves and tried to find a way to provide flexibility. And what we sort of took a step back and realized is that 43% of Washington, D.C. is impervious. Less than 1% of that land area in the district, though, triggers our stormwater management regulations in a typical year. So there's huge amounts of the city that aren't triggering our regulatory requirements, where people could voluntarily install green infrastructure. And we thought surely there's a way to take our problem of impervious surface that's so vast in the city and turn it into a good thing, turn it into an opportunity for credits to be generated that would provide flexibility to regulated development, and also incentivize people who want to build green infrastructure to give them a financial return for doing that. So in addition to being controversial and scrutinized by the development community, our stormwater regulations are closely scrutinized by the environmental community, and that's because the environmental community realizes how important these regulations are. The stormwater problem for us is, particularly in the MS4, is one of volume as well as one of what's in the volume. But from a volume perspective, you can see this picture of this small stream, deeply incised stream channels, from that huge volume of stormwater concentrating off of those impervious surfaces, washing into our streams, gouging out the stream channels, and putting that sediment load into our streams and downriver. So it's in this MS4 part of the city that we have most of those small streams and creeks that are so vulnerable to the impacts of stormwater. And the other thing to keep in mind is stormwater is not just a problem of volume, but all the stuff in it, the trash, the oil, the grease, the pet waste. And what we sort of realized is that if we could come up with a way to provide some flexibility in terms of where green infrastructure is located, that could be a positive thing, because green infrastructure located in the MS4 part of the city provides a lot more benefit to us, to our city, to our water bodies than it does when it's in the combined sewer system. And that's, first because the tunnels are already being installed for the combined sewer system, but also because we have our most vulnerable water bodies out in the MS4 area of the city. And then, in addition, those small water bodies that are up here, they all drain into our big tidal rivers, the Anacostia River and the Potomac River. So when we do something upland to benefit the small streams, it's also benefiting the bigger rivers downstream. From an economic perspective, there's some rationale for doing more green infrastructure in this part of the city too, because it's less expensive there. You have more open space, you have lower land values, which make it easier and less expensive to build green infrastructure in those parts of the city. These parts of the city, especially in this area to the east of the Anacostia River, but also along here, these are some of our least affluent communities in Washington, D.C. So getting more green infrastructure in these communities also provides some environmental justice benefits. So what we realize is that having a regulatory framework that applies citywide, but allows smaller green infrastructure to be installed in the combined sewer system and as a result gets bigger green infrastructure installed out in the, or more green infrastructure installed out in the MS4 part of the city, that this would be a way for us to optimize our environmental outcomes. You know, traditional regulatory approach would just have the green infrastructure installed wherever the developer happens to choose to do their project, not where the green infrastructure provides the best benefit. So this flexibility from credit trading, not only did it provide flexibility for regulated development, but it opened the door to this possibility of optimizing our environmental outcomes, shifting green infrastructure and the millions of dollars that are being invested in green infrastructure by private development to the parts of the city that need that green infrastructure the most. There's also some optimization that can occur in terms of the sizing of green infrastructure. Basically, smaller green infrastructure practices that serve a larger area provide more benefit than larger green infrastructure practices that serve a smaller area. I'm not going to get into a lot of detail about that, but I'm happy to talk with folks offline about that. So basically, our proposal and our solution to this challenge of optimizing environmental outcomes and providing flexibility was our stormwater retention credit trading program. Basic idea is that if you're a construction project that triggers our stormwater management regulations, you have a requirement to achieve half of your obligation on-site, but after you've done that, you can achieve the remainder off-site. For example, if you have a development site that post-project will have 14,000 square feet of impervious surface on it, your performance requirement, your performance standard is to capture the volume from a 1.2-inch storm. That would equal about 10,000 gallons. Your on-site minimum is 5,000 gallons. So if you're a regulated site that decides to use our off-site program, that off-site obligation becomes a permanent obligation for your property. It's recorded with the deed for your property, and it's an annual obligation. This is not a pay one time up front and you're done kind of program, which is sort of typical for how these programs are set up. Ours is an annualized obligation, which is important for a number of reasons that I'll talk more about. If you are that regulated site, you have two options to achieve your off-site retention volume or your off-site obligation. One is to pay a fee to the government. We don't think we're very cost-effective in doing this work, but we take that money and go out and build green infrastructure on your behalf. That's currently set at $3.58 per gallon per year. The other alternative is the use of privately tradable stormwater retention credits. And a credit is also 1 gallon of retention for 1 year. So this is an apples-to-apples comparison. You can either pay $3.58 to meet your obligation for 1 year, or you can use 1 credit to meet your obligation for 1 year. The average price at which credits are trading is about $1.85. So it becomes a pretty just sort of rational decision between paying $3.58 or paying $1.85 to meet your obligation for that 1 gallon per year. Okay, so the first way in which we're really scaling up green infrastructure, as just to recap, is by getting these new stormwater management regulations in place. Our market-based credit, our stormwater retention credit market is something that allowed us to take that step of getting those regulations passed, of making sort of harnessing the power of development to get green infrastructure installed in the city. If it wasn't clear, the reason why that development results in green infrastructure retrofits is because we're already built out. So these development projects, these are not projects that are affecting meadows or forests typically. They're projects that are redeveloping existing parking lots and buildings. So whenever those projects trigger our regulations and they put in place green infrastructure, it's resulting in an improvement of the stormwater runoff situation for that property. So that's a very different situation. Our really urbanized context is very different from some other places that are less urbanized, where you have development that's primarily, greenfields development. So that's sort of an important fundamental point. The second way in which we're trying to scale up green infrastructure by using our credit market is with a credit purchase program. Basically, our agency is setting up the ability to buy credits from people who voluntarily generate them. And this is, you can think of this as a pay-for-performance contract. Again, the performance metric is 1 credit, 1 gallon of retention installed and maintained for 1 year. We certify credits on a 3-year cycle, so we'd only be paying for up to 3 years at a time. That becomes important as we talk about this more. And it's an option contract, so a credit generator has the option to sell to our agency the credits that they generate per the terms in their contract. That means that if a regulated development site offers them a higher price, they're free to sell to that regulated site. Basically, what we're doing is providing a price floor. We're giving some certainty to private investors. property owners and credit aggregators about the return that they'll be able to make on their investment. This is, even though this program won't be fully available until spring of next year, we've already started to see some investment. There was a $1.7 million investment from Prudential in a firm that's actually a spin-off of the Nature Conservancy that's helping to do some of this work. There's about a half dozen other firms that are getting set up to do this kind of work in the district also. And this program is only available for green infrastructure retrofits in the priority areas of the city, so basically the MS4. We really want to sort of put our thumb on the scale of this regulatory framework and get as much green infrastructure installed in the MS4 as we can, because that's where it's going to provide the biggest benefit. We've put aside $11.5 million for this program. Basically, it's a pilot project to sort of tie back to some of the points that Daniel and Jen made. You know, our intention is absolutely to be finding ways to borrow from the future if we can get this program to work the way we want it to, and it's providing us the benefits we want it to provide. We want to scale up our investment and do more sooner so we can accelerate the restoration of our water bodies. Okay, so just to illustrate how this works, if it's not clear, you have an investor. They give money to a credit aggregator. That credit aggregator goes out to a property. They install green infrastructure like this bioretention. They retrofit that property. As a result, our agency, DOEE, certifies credits for the property after it's met all of our design requirements and inspection requirements. They'll get credits. They give them back to the credit aggregator, presumably. And that credit aggregator, if they're going to take advantage of our purchase program, would sell the credits to our agency. They get that money back. Or alternatively, they sell the credits to our regulated development site. And that money, in either case, would go back to the investor. Just a quick point is that we have a layered incentive here that operates, which is the discount on our stormwater impervious fees in the city. All property owners, this doesn't have anything to do with whether or not you're going through construction, all property owners with impervious surface pay a stormwater fee based on the amount of impervious surface on their property. If they install green infrastructure, they can get a discount on that fee. So there'll also be a discount coming from our agency to this property owner. Okay, so why are we going down this route of using the credit market to invest as a government in retrofitting our land area to provide these benefits to our water bodies? There's a number of reasons and sort of benefits that we see for doing this. One is we see this program as being able to shift the risk of maintenance failure from our agency to the credit aggregator and the private property owner or the investor who are doing this work. And that, to explain that, I should say, traditionally what we've done as an agency is pay either our sister agencies or a private property owner to install green infrastructure on their property. We're paying the entire cost of that project up front. So remember, that green infrastructure might have a 20-year or 30-year life cycle. We pay the entire cost up front. If that green infrastructure doesn't get maintained, we have a hard time in those voluntary scenarios of making the property owner maintain that green infrastructure. So there's a real, and of course the green infrastructure doesn't work if it's not maintained. So there's a risk that if that doesn't get maintained, then we've really made a bad investment. We paid for 30 years of value, we only got the value that was associated with that time period that the maintenance actually occurred. So because we issue credits on a 3-year cycle, and we conduct inspections before we issue a new batch of credits, if you're not maintaining your green infrastructure, you're not going to get any more credits. We're not going to pay anything more for that green infrastructure. So we're shifting that risk of maintenance failure from us to the private entities who are building the green infrastructure and are responsible for it. There's another risk that's sort of tied in with that, which is the risk of our agency selecting a site to build green infrastructure that basically would otherwise trigger our stormwater management regulations anyway during the life cycle of that green infrastructure. So, remember, the green infrastructure has a 30-year life cycle. When we pay for green infrastructure as an agency, if we're going to pay for that entire cost up front, we want to make sure we do that on a property that wouldn't otherwise be going through development that triggers our regulations. Because if they go through that development in 5 years, we've paid for 30 years, but after 5 years, they would have installed that green infrastructure anyway. We only really got 5 years of value from our 30-year investment. That wasn't a really smart investment for us. And our crystal ball, in terms of knowing what property owners plan to do with their land, is not very good. So, we always have this risk that if we pay for the full cost up front, we pick a site that would have triggered the regs anyway. That wasn't really a good use of public money. So what we're doing with the credit purchase program, again, because we only certify credits on a 3-year cycle and we only pay on that 3-year cycle, we're shifting that risk from the government, again, to the people who are installing the green infrastructure on their own property, the private property owner, the credit aggregator, and to some extent the investor who's supporting the whole project. Credit market also is really good at looking for opportunities not just on public land but private land. A lot of our biggest projects have been on public land, and it can be a little harder to do big projects on private land. The market doesn't have that limitation. It creates an incentive, this sort of profit motive for people to go out and find the best opportunities throughout the city. We believe that typically the private sector can build the green infrastructure at a lower cost than we can build it ourselves, and we're not going to pay more for these credits than it would cost us ourselves. So the idea here is that we're saving money for our ratepayers relative to the government doing all this work itself. So that's another benefit of the credit market. And another really sort of fundamental point here is that our approach really is kind of all premised fundamentally on the idea that the externalities of stormwater runoff really should be internalized into the costs of development. Fundamentally, stormwater runoff is a problem of developed area, and the costs of that stormwater runoff, those harms, those environmental harms and community harms, should be really worked into the cost of that development. So that's what our regulatory framework is all about. This is a really sort of simplified projection of how our regulations would result in retrofits of the MS4 area of the city over the next several decades. You can see it's going to take us a long time for that process to happen. The credit market allows us to shift. This purple would be shifting green infrastructure for the combined sewer system area of the city over to the MS4, so that would sort of accelerate our progress. And then the other thing is in blue would be showing the government's investment in buying credits to get this green infrastructure built. And one of the points about this is that because credits are annualized, we can pay for credits, we can scale up our investment, and then we can scale it back down. We're operating within the regulatory framework. The credits are part of the regulatory framework. So as the demand for these credits will grow over time, gradually more and more of these costs will be borne by regulated sites that need to buy the credits, or because the properties that are generating those credits have gone through a development project that's resulted in that property installing green infrastructure anyway on its own. So that's a quick overview of the benefits of that approach. Some quick data on our market. We've had, it's still pretty early on for us. Our regulations took effect in January of 2014. We've had about 10 trades. Most of them have been in the last year, about a little less than $100,000 in value. Our average credit price is $1.85. About 12% of the regulated projects that come through our process are opting to meet some amount of their obligation off-site. To understand how this market is working, you do need to understand that a regulated site, if they build green infrastructure on their property, they don't have to have that green roof or rain garden or whatever it is installed until they're at the end of construction. That's when they have their final construction inspection by our agency. Everything needs to be operational. The same thing applies if they're using credits to meet their obligation. They're required to buy those credits at the end of construction. And most of the projects, the kinds of projects that trigger our regulations, these are not small-scale homeowners. These are like large buildings that can be, 2 to 5 years from permitting through the end of construction. So our requirements took effect in 2014. Only about 10 of the sites have gone the whole way through construction and actually are using credits. But we're seeing this acceleration, right? 10 trades since 2014, 8 of them in 2016. More and more of these sites are completing construction, and more of that demand for credits is materializing. So we expect that demand to keep growing. Right now we have, a pretty, at least by one measure, a reasonable balance between the amount of demand and the amount of green infrastructure capacity that's out there to meet that demand. But we certainly expect this demand to be growing over time, and we're looking forward to seeing the credits also grow over time. As we hoped, most of the credits are being generated in the MS4 part of the city, and they're meeting demand in the combined sewer part of the city. And I'll wrap it up there. My information is there, and some web links for more information on our programs is available at these websites. And thank you very much to everyone for participating today.
Thank you so much, Brian. That was really illuminating, especially as a DC resident myself. I'm cognizant that we are a little bit over our allotted time today, but any attendees who would like to stay on and ask a question or hear some Q&A, I know that I can stick around, Jen can as well. Any of the other panelists, obviously feel free to leave if and when you need to, but if you do have an opportunity to stick around, that's great. So I'm going to go ahead and just unmute our panel here. The first question that comes in is, could you talk about developing countries specifically and the implications of green infrastructure for the poor in rural and urban areas? This one might be interesting to get perspectives from both Brian within DC and maybe also from Dan internationally.
Yeah, I wonder, Brian, do you want to talk a little bit about some of the livelihood benefits within that kind of M4 area that you were talking about?
Well, the MS4 area, I mean, there definitely are, you know, a number of ancillary benefits in addition to the water quality benefit, if that's what the question is looking at. And you know, while we're not a developing country, we do see this opportunity to shift those ancillary benefits to the parts of the city that are least affluent and really the parts of the city that need those benefits the most. So we're talking about things like reductions in urban heat island effect. This is a really important one. There's a lot of health impacts from the heat and the extended days of heat in a city like Washington, D.C. But there are other benefits. There's some air quality benefits, and then there's certainly habitat benefits and aesthetic benefits. And then just sort of like community amenity benefits in terms of, you know, if we can restore health to some of these small streams and creeks that run through our communities, we're providing a better resource for that community to, you know, to be able to enjoy for recreation or you know, however they choose to use that area.
Yeah, I think that's similar on our side. You know, there's always these recreational benefits that accrue closer to the green infrastructure is installed. I think beyond that, though, especially in emerging markets or the global south, installing, maintaining green infrastructure is labor intensive. One of the most famous efforts to remove invasive species in a drinking water source in the Western Cape of South Africa, you know, employs over 50,000 people a year. I mean, this is a working lands program. So you're just talking about the direct benefits of kind of labor, job creation within often kind of depressed areas. The second one is, remember, the main hydrological or environmental service you get from maintaining the health of a watershed is the water itself. It is the predictability of that clean water. It is the you know, predictability of the timing of that water. So especially in developing countries, it's still the case that rural access to water lags behind urban areas. And so it is the very populations that we work with in watersheds that most directly rely on the environment for drinking water. And so we often talk about the benefits accruing downstream within reservoirs and hydropower operations, and we get into a lot of mumbo jumbo around return on investment to bulk water users downstream. But if you are in the Upper Tana, you go to the river yourself for drinking water or for water for agriculture, you don't have the benefit of some of that traditional treatment infrastructure. So I think both on the recreational side, potentially the job creation side, and then on this drinking water side. The last thing I would say is also, when you're not just installing forests and reforestation and the kind of traditional things you think of when you think of green infrastructure, we include in that package a lot of agricultural best management practices. So in that Tana example in Kenya I mentioned, we're really talking about a lot of terracing of land, riparian buffers, drip irrigation, all of which culminate in greater soil retention on a farm, greater soil health, and that translates often into greater production. So if you're enlisted in this program, and this is one of the things we monitor, is what is the kind of yield difference between a farm who is working with the watershed conservation techniques and those who are outside of the program. I'll stop there.
Yeah, and if I can jump in and add one more thing, we do ask when we survey all these program developers to tell us, are you seeing benefits for communities? Are you seeing, jobs or training opportunities or climate resilience enhanced? And that is something we discuss in the report. I think one of the challenges we run into is, I think programs are absolutely, seeing these benefits, but they're measuring them in different ways, and different places obviously are going to have different challenges and different needs. And so it's been an interesting conversation that we've had at Forest Trends. How do we really track that kind of impact in a meaningful way? I don't know that saying incomes were increased by X dollars last year would tell us very much when we're talking about a global scale, but if you take a look at a report, we do kind of dig into some of the metrics that we're hearing from programs, and it's something that I'd be very interested in hearing from the people on this webinar about as well. How can we do a better job of talking about implications for the poor and rural and urban communities?
Thanks, everyone. I might just stick with Jen for this next question. You mentioned during your presentation that user-driven programs aren't particularly big. What is the average size that you found in your research?
Oh, good question. So I think that so this is actually in the report as well, and I think our average size was about $850,000 worth of transactions or payments a year. It is really interesting. That's actually a big jump from the last report. So these programs are kind of getting bigger, although they're still, we're talking about under $1 million a year as kind of the global median size. And as far as how big they are in terms of impact, that's something I would have to take a look at in our data as far as size or the sort of hydrological benefits that are being measured.
Great, thanks, Jen. Another question here posed to Dan. You mentioned that water funds have raised about $300 million. Can you talk about what the value proposition is when they're approaching the private sector and asking them to back something that's kind of untested from their perspective? It looks like we may have lost Dan there for a second. Right on cue. Jen, do you want to go ahead and actually use this opportunity to ask one of our poll questions while we still have so many people on the line?
Sure. Hopefully it'll go a little more smoothly this time.
And
so I would.
Oh, sorry. Go ahead.
Well, I would be interested, we've been talking a lot about sort of some of these challenges for scale, and I think Dan and Brian both had some really interesting comments on that coming from their respective angles. But if the folks on the call right now would like to quickly respond to that poll that you see here on your screen. Great, so I'm seeing numbers coming in. Very interesting. Okay, well, maybe I'll give you all another 15 seconds to respond to that if you want to ask another question, Dan.
Yeah, sure. I see that.
Or Will, rather. Sorry.
No problem. I see that we have Daniel back on the line, so I'll maybe pose that question quickly again. Dan, you mentioned that water funds have raised about $300 million. Can you speak about what the value proposition is when they're approaching the private sector and asking them to back something that's kind of untested from their perspective?
Can you hear me okay, Mil? Well?
Yeah, I can. You're loud and clear.
Awesome. Yeah, that's a great question. So, the private sector interest in this kind of ranges quite a bit, right? You can imagine if you are even a small water user inside of an area, so your kind of operations aren't highly reliant on water, your brand may be highly related to water things. So maybe kind of a license to operate issue. Certainly something we see a lot within the beverage industry, where they're not necessarily the dominant water user, that tends to be agriculture, but that their ability to operate effectively, within these communities depends on that. The other is also true for companies that have very little to do with water, but have a huge employee base, right? So, those are the communities. So shocks in the communities, shocks within their employee base, that has a major impact on their ability to kind of operate. And again, employee retention is a big part of this. So we see a lot of, on that kind of more CSR side, that's the corporate social responsibility side of things, companies that are good corporate stewards within local communities having an ability to kind of attract and retain talent. So that's the kind of traditional things you think of when you think of corporate giving within the conservation and environmental movement. However, there's another class of investors that are a little bit more where their assets are greater, where they actually are large water users, whether they're agriculture or industry. And really, their willingness to pay depends a lot on the ability for conservation to kind of reduce the water risk associated with their operations, or deliver a hydrological service that they depend on. So we work, for example, with a number of private water utilities. These are large water service providers, where we essentially are monetizing the savings in water treatment that they can accrue through improved water quality upstream, even the forestalling or the postponement of large capital expenditures as a result of maintaining certain hydrological features. So it's not necessarily always improve water supply, it's can you maintain specific services. And then, again, that always depends a little bit on the assets at play, right? So the larger that private sector actor is in terms of relationship to water, the more they're going to be willing to participate in our experience.
Great, thanks, Dan. One more question here, and then I'll let everyone hop off the line. And let me just briefly point out that any users who, any attendees who would like to ask another question, please feel free to go ahead and just submit it in the question box. That way we'll have it captured, and we can try to connect offline with one of our panelists. So this last question coming in, will improving metrics increase the cost that users pay for green infrastructure? And if so, how much? I'll just go ahead and pose this to the field.
I'd love to hear what Brian has to say, given how you guys have a real verification process there, how big of a burden that is. I'll just say that we have a hard time persuading investors that monitoring and evaluation is as critical component. But while that may be upfront a challenge to kind of, because there's quite a high cost both in terms of equipment and labor associated with monitoring and evaluation, ultimately, as these programs mature, we realize our investors, our stakeholders really want that information. We kind of recommend, when we think of kind of, the cash flow, financial plans for a program, to think of monitoring and measurement on the order of about, 4 to 5% of operating costs. So that's kind of a rule of thumb. It's not perfect, but something that we keep in mind as we like to encourage that in a lot of our programs.
This is Brian. I would say, it sort of depends, and I think it depends in part on what are the needs and the desires of the people who are either paying for or sort of demanding regulatorily that this work to get done. And so I think, for us, our primary focus is on, water quality benefit and figuring out, quantifying the volumes of stormwater that are being captured and prevented from, harming our water bodies. So we track that very closely. And, I wouldn't say that that's a huge cost to us, but it is. We have a lot of people who play various aspects of that. We have a team of review engineers who review plan designs to make sure that they're designed to achieve the right environmental performance. We have another team of inspectors who go out and inspect during construction and then after construction for maintenance to make sure the stuff is being done right. And then we have people sort of administratively who work on sort of our data systems for tracking it. So while that is a cost to us, compared to the cost that's being invested by regulated development into the construction of the green infrastructure, it's pretty minor. And it's something that we need to be able to, think strategically about the progress we're making to restore our water bodies, and also to report to, the Environmental Protection Agency that, we're responsible to ultimately. So I think it does depend a little bit, but having said that, I think sort of, echoing what Dan said, or maybe I'm misunderstanding, but I think I'm echoing, I think even though some of this stuff can be hard to capture, like the number of jobs created, or reduction in urban heat island, or other kinds of benefits, or carbon sequestration, like not all of the metrics have been worked out for what the right way is to capture that kind of information. For example, for runoff reducing green infrastructure. However, if you can do it and quantify it, and maybe even monetize it, you have a way of being able to maybe find new sources of funding to support that work. So if there's somebody out there who's really interested in carbon sequestration or reduction of urban heat island, and we can quantify those numbers and report to them, then maybe we have a new source of funding and revenue to support this larger work that we know is beneficial, not just for water quality, but for these other parameters. So I would say that even though it can be costly, I think sometimes the cost, it may be upfront a cost, but in the long run it might be offset by additional sources of, funding that could be committed.
Great, thank you both. With that, I'll go ahead and wrap things up today. I just want to quickly sincerely thank our panelists today, Daniel Shimmy at the Nature Conservancy and Brian Van Wy at the DC Department of Energy and Environment, as well as Genevieve Bennett, my colleague at Forest Trends Ecosystem Marketplace. I think this has been a really informative discussion. It's been great to get such varied perspectives on the landscape of green infrastructure. And for all of our attendees, I would encourage you to go to either forest-trends.org or ecosystemmarketplace, all one word, .com to download the new report, Alliances for Green Infrastructure, the State of Watershed Investment 2016. You'll be receiving some follow-up materials from us, including a recording of this presentation, and as Jen just pointed out in the chat box, I believe you all should have received, we will be sharing the results of the polls that we collected today. So thank you all for attending, and have a great afternoon.
Yeah, thanks all.
Yeah, thank you.
Bye-bye.
Thank you.